Hello, hello, hello. People are coming in. People are joining. If you don't want your wonderful faces on camera, you can always shut off the camera. Uh, and if you can mute yourself, that'd be great too. So there's no background noise. We're gonna get started. I want to be respectful of your time, so we're just gonna wait 1 minute exactly, and then we'll get started. We'll get into who I am, the main SBDC on the screen here. You can see our figures from 2024 and soon to be replaced by 2025 figures. But when you take the 132 new businesses started, that means every 2 days or so we help a business start in Maine. So I like that. I like that little stat and all that other stats. So it is 11:01 and you people came on time, so you get the reward of let's start this webinar, right? And this webinar, we're going to talk about the economic impact and mysteries of the Maine tote road shagama. We're going to go through the intricacies of how this animal has affected small businesses and why 440 steps on its front paws and back paws is a weird thing to think about. But I'm just kidding. We're going to talk about pricing, 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 people. Okay. This is a webinar all about pricing. So hopefully you are at the right place. That was just a little get you to wake up in the morning for the Shagama, though it is a local legend, so I do think you should look into it. But for pricing, 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 we're going to go through this presentation, and it's designed to help you understand how to put your pricing together. And more importantly, for a lot of people on this webinar is how does my pricing get affected or influenced by if I decide to wholesale or not? What does that mean for my pricing? This is the third part in a 5-part series that we put on every year for the New England Made Show. And if you have questions that come up, please put them in chat. Okay. And I'll put a hello in chat so people know. If you're new to Zoom, down on the bottom, there should be a little blinking light. That's where the chat is. Feel free to put questions in. If it's a very specific question to your business and it only pertains to your business, my email address is right here under my picture, peter.harriman@maine.edu. So just send me an email. I'll be more than happy to talk with you about your specific situation. Otherwise, general questions in chat. By the end of this presentation, I'm hoping that you'll be able to really understand what it means to think about your pricing and how it is going to be affected if you decide to do wholesale, right? Even if you don't do wholesale, just how to get to your price, right? A little more systematic. As I said, this is part of a webinar series that we do for the New England Made Show. Great partners. It is going to be March 14th to 16th this year in Portland. We've already done 2 webinars. This is the third, and there's 2 more webinars that you can do on February 3rd and February 24th. How to design a booth for a wholesale trade show, which gets into a lot of the intricacies of this specific show especially, and a panel discussion, what I wish someone had told me about the New England Made Show, which is great because you get to ask actual people who've done the show what the show is like. It's really an intense show. It's great. I can't speak more highly of it than I do. And we do have Stefa on from the New England Made Show and Whitney somewhere, I thought, as well. If you're interested in one of those other 2 webinars or both, they're on our website. Again, February 3rd for the how to design a booth, and then what to expect at the NEM show for February 24th. So feel free to sign up for them. If you miss them or any of the other parts, we do put it on YouTube. So if you look at our wholesale, our channel has different categories. You look at the wholesale, and or you just subscribe so you don't miss some of these great webinars that we do. Either way, you'll get notified of the things that we're putting on, and then you can look at it yourself on your own time. Right now, the agenda, we're going to go through a brief introduction of who I am and why I'm talking. Then we're going to get jumping right into pricing, then wholesale, and a lot of terms that you might want to know. Then very briefly, some common pricing strategies and issues that come up. And then we'll wrap up with questions, of course. Right now, there's a lot of content to go through, but again, just throw your questions in chat, and it'll either be answered later or answered by someone, maybe an SBDC rep on the line. Okay, so who I am, or who am I? Peter Harriman. I work for the Maine Small Business Development Center out of the Portland Center. I've been here for 10 years, scary enough. So I've seen things. I'm like the worn-torn veteran of the Small Business Development Center. Um, we are a group of 21 locations across the state of advisors. And what we do is one-on-one advising. So we can do in-person advising, we can do Zoom advising, we can do telephone advising, email advising, however it is best suited for you. Our bread and butter is one-on-one advising. And we are generalists. We know a lot about a lot of things, but we can also order research reports. We have other partners in the ecosystem of Maine, so we can get you to the right person to talk to. So there is no wrong door with the Maine SBDC. We like to help. The main goal is to help you get started and stay in business. That's a really important part, right? Is we want to teach you the methods and the method behind the madness, so to say, to keep your business going. Because it's really easy to start a business, not as easy to keep a business going, right? So we want to make sure you survive as a business, right? What we are not lawyers, we're not accountants. So I've been here for 10 years, so I've seen a lot of things, but if I tell you something I might follow it up with, it would be a good idea to talk to a lawyer or it'd be a good idea to talk to an accountant about this. And I mean that because I don't buy insurance to cover myself for legal or accounting matters, right? So keep that in mind. So, whoop, people excited. How do we cover the whole state of Maine? We cover the whole state of Maine by partnering with the University of Southern Maine, Northern Maine Development Commission, and AvCog, right? And that way, wherever you are in Maine, there's probably a reasonable drive time to get to an office if you want an in-person meeting. Since COVID, Zoom's been all the rage, so we can certainly do that as well from anywhere. As I said, we got a great team. This is the website if you wanted to sign up for advising. All you have to do is hit that request advising in the top right corner. Once you hit that advising, you'll fill out a form and you'll be paired with an advisor who will get in touch with you. Again, we do have a YouTube channel, so you can always subscribe to the channel and get these webinars if you're interested in content on your own time. Right? Now, you didn't come here to hear me talk about that. You came here because you're really curious about pricing, pricing, pricing. So on with the show. We're going to start with the game. Family Feud style, for those who still remember the Family Feud, right? So how do you figure out your price for your product? And I often ask my clients this before we get into the pricing when we have a one-on-one session. So the number one thing I hear from clients, or number five, I guess I went the reverse way, sorry. Number five, gut feeling. It just feels right to do this. Okay. Number four, which is actually might be overtaken to number three soon, is AI. They put into AI, what should I sell my product for? Right? And AI comes up with something. Number three, cost. Someone actually goes through the cost and tries to figure out, hey, this is what I should sell it for, which is a little bit of what we're going to do. Number two, competition. And number one, they have some kind of industry knowledge. So the people that come to me and say, hey, I want to start XYZ business. Why do you want to start it? Because I know the business. I've either worked in the business or I followed the business for a long time. So I have a lot of industry knowledge. Now, all of these aren't necessarily bad unless you're only doing one of them, right? And that's what we're going to get into. Pricing is a little more complex. So if you're just doing one of these, guess what? The helpful hint, you're going to need to do more than one. So let's get into it. Where are you at pricing? And this is where the conundrum comes in with wholesale, right? If you're a business and you're thinking, hey, I'm just going to sell to an end consumer, right? Pretty straight line. Whatever I sell is going to be that price to the end consumer. Well, what happens if you add wholesale in and there's suppliers and vendors, or there's a wholesaler distributor that you work with, right? And now this line gets a little more extended, right? Where you're now the supplier or vendor on one side, and then it gets shipped to the wholesaler, shipped to the retailer, and then finally ends at the end consumer, right? The complexity of pricing is that as it's going down this line, it's changing price. And we got to understand how it's going to change so we understand what that price is the end consumer is going to be faced with. Because if we get that wrong, they might find your product unappealing because it's too high of a price, right? If you haven't factored in for that. So There are, pricing strategies. I'm just going to take this away. There's pricing strategies, there's target market, there's competition, there's your branding, distribution channels, your cost. And in some extent, pricing is really about predicting the future, right? Because as we've seen with, the next slide really puts it on, tariffs, as we've seen with inflation, as we've seen with supply chain issues, if you don't factor those in, you're going to be behind the curve, right? You're always going to be playing catch up when it comes to pricing. So in some context, you have to understand what is happening in the news in the world to make sure you understand how you should be pricing your product and how it's going to affect your pricing. So it is a complex. It shouldn't be just one thing, right? But the first step I'd like to really highlight, the very first step in pricing is that you research, that you really understand who your target market is. You understand what channels you're going to sell through, and you understand your competition. We're going to get a little further into that, but that's always the first step I highlight. You can't just jump into pricing from the get-go. You really should do your first step of research. What is your business? Who is your client, right? Because that's going to really, really come to play later on, right? So research first is your first step in pricing, right? Now, when we talk in this webinar, we're really going to focus on price point determination, which is actually understanding where the price should be. And we're going to talk very, very briefly about pricing strategy, but there is a difference, right? Pricing strategy is all about marketing, like the buy one, get one. We're not going to talk so much about that. We're really interested more in the price point determination for this webinar. So what are the three methods to determine your price point, right? And a business owner needs to have an understanding of their product and service, right? But the first one we're going to go in depth on is the cost basis, right? Second one is going to be the market basis, i.e., what are your competitors doing? The third one is market acceptance or sometimes customer perception or branding. We're going to go through each one of those. As I said, one is going to be a little more in depth, then we're going to talk about 2 and 3. Now, the hard part for a business is that a business owner needs to consider all three of these, right? Remember that Family Feud? You can't just do one of them. You have to do all three to really understand what your price point should be. Now, let's dive into number one. How do you determine the cost basis, right? We're first interested in what is our minimum price that we need to sell. Minimum price is basically at what point do we not make money and not lose money? So, you could call it break even, but I call it minimum price, right? Because you can't go below it without losing money. So this is your minimum price tier, right? We break down the process into 4 steps usually, but Wholesale adds this 5th step that we'll get to. Step 1 is we're going to look at the direct cost. This is often called the cost of goods sold or a variable cost. And that can be materials, ingredients, what is going into each product directly. How much does each box and each sticker and each label and the postage, how much is all of that for each particular item, right? That's the direct cost. Could also be labor in your direct cost. So we're going to get to that. That's why there's a little star there. We're going to get to that in a second because there's a couple different ways you can deal with labor because that's a little sticky. But labor could be a direct cost in, how much do you pay someone to put that widget together, right? Now, going deeper into labor, there's really 2 basic methods of calculating labor costs, right? There's the cost of goods sold, which is that direct link, the breakdown of labor for each product. And then there's just putting the labor costs into an indirect or overhead bucket, right? Think of it as like a fixed cost, right? And to get into that a little more, an example of the labor cost being a direct cost would be like if a business is focusing on one piece at a time. So when you hire someone, they can only focus on this one thing at a time before they move to the next one, right? So a jewelry maker is a good example. How many earrings can you make in an hour? And let's say in 1 hour, this person that's a jewelry maker can make 3 earrings, right? Well, what's your hourly cost? Well, let's say the hourly pay rate is $17.50 an hour. and your hourly cost, we're going to add 20%. Now, why do we add 20%? Because if we pay someone $17.50 an hour, the 20% reflects what the company is going to pay above and beyond for Social Security, Medicare, unemployment, and workers' comp, right? So we want to make sure we factor that in. We're not just paying that person $17.50 an hour. We're actually going to end up paying them about $21 an hour when we get down to it. So when you're looking at the labor cost, and if it's a business that's focusing on one piece at a time, then we want to really look at the cost of goods sold and break down that labor cost, right? So in this example, we know it's about $7 per earring is a labor cost. So we can attribute $7 in labor for each earring that's made, right? If they make 3 in an hour. This is also an important metric to have if your business is run like that, where it's one piece at a time, because now you can understand how productive your people are. So if you have one worker who's making 4 earrings in an hour and you have another worker who's only making 1 earring in an hour, you can kind of see what's going on with productivity levels. Maybe earrings aren't their job. You need to switch them to bracelets. I don't know. But it's a good metric to have so you can kind of plan on what your costs are going to be. You say, okay, we're planning on $7 an earring for the cost for a direct cost. Now, let's say, because I get this a lot, someone comes in and says, Pete, I'd love to do it, but my business is one, it's like a bakery, right? And it's a business focused on many products at once. While those are cooking, they're making something else. And while those are cooking, they're making 12 other different things, right? So there's a lot of things going on. So at no one time are they stopping and just focusing on this one thing. So I can't do, they make 12 loaves in an hour because they also made 26 muffins and 13 of this and that, right? So with that, rather than focusing on one at a time, one item at a time, I would say put the cost of that baker, the labor costs, into just an indirect, right? Into a salary. In this case, let's say they work 40 hours a week at $18 an hour, so that's $720 a week, times 52 weeks, 37,440, times that 20%. Remember that 20% covers the business's cost for Social Security, Medicare, unemployment, workers' comp, right? And it might be more, right? But 20% is a good kind of rule of thumb. So really, that 37,440 is really 44,928 is what it's going to cost that business to have that baker, right? And so now we can put that into an annual number. In a few slides, we're going to see how we can put that annual number to a product, right? We're basically going to divide it by sales. So continuing, the next step after you do the direct cost, step 2 is the indirect cost. And this is the hardest step because it's got a few things you have to guess at, especially if you're new to business, right? Now, if you've got historical numbers, it'll be a lot easier. But if you're new to business, it's going to be a lot harder. Even if you have historical numbers, you're still guessing because you're looking forward in time. You're looking at this next year, right? So you're going to have to determine what is my annual overhead cost going to be, right? And what is my annual sales in units going to be? The overhead cost does not include the direct costs that we've already factored in step 1, right? So step 2 is not direct costs, it's annual overhead indirect costs, right? So that could be rent, it could be insurance. It's basically a cost where it doesn't matter how many products or widgets are made or sold, because that is going to be the same. Your rent is going to be the same from one month to the next, no matter how well or how not well you did, right? So this is referred to as fixed costs. And as I said, you could try to put labor in as a fixed cost if you feel you can't really put it in as a direct cost. You can't attribute a particular labor amount to an item, right? So there's two things there. Now, the other thing to keep in mind, because remember, this is the hardest step 2, the indirect cost, is you might have costs that are coming up in the next 2 possibly 3 years. I wouldn't look out any further than 3 years necessarily, unless it's a really big cost. But let's say you're working, you have a home business out of your home, and you're thinking about taking on a rent and moving into an office space, right? Well, that's going to increase your cost quite a bit, right? So when you're doing your projections, for those who have a history, have a business already, and they're like, oh, I'll just take my annual overhead from last year. Well, you do want to pepper it in with, my costs are going to go up quite a bit in the near future. So in order to not have a really big price increase, I can either slowly get up to that cost if I think it's going to take 2 or 3 years and I know what that ramp up is going to be, or I can try to incorporate that cost now so there's no effect on the customer, right? So we do want to take into effect, what are we planning in the future? Because that future might change, right? And we don't want to underprice ourselves where the future growth can happen. So we're going to use the equation, the overhead cost divided by annual sales. And this is if we only have one type of unit, right? So the short example is, let's say there's $30,000 a year is your overhead cost, and we sell 2,000 units. Well, 30,000 divided by 2,000 means, for the step two indirect cost for that item, we're going to have $15 per unit. And remember, the other hard part is you're trying to estimate how much you're going to sell. We're assuming we're going to sell 2,000. That's our goal. And this is something I see all the time, is a business, when they get started, they don't set up goals for themselves, right? They don't set up projections. Well, this is your hint that projections should never end. You should be setting up projections every year. So in this case, 2,000 units is where we're hoping to hit. And we know that $15 per unit is what we need to make sure we cover in our pricing to cover all of the overhead costs, right? Now, this is where I get a lot of people say, Pete, this is really straightforward and simple, right? What happens if I have more than one type of unit, right? I'm selling multiple things. I'm not selling just one. Great. Okay, you have more than one product. Go you. Awesome. You can start kind of the same way. You have to find your annual total overhead costs. Again, this could be an estimate, and if it's going to change drastically, you want to kind of incorporate that change. But let's stick with that 30,000 we just had in that last slide. So $30,000 a year in overhead, right? Then we're going to look at our historic or projected sales, right? And 50,000. We think it's going to stay at 50,000. Either we're projecting 50,000, or we've got a good case study to say we're going to sell probably 50,000, right? Now, how is this 50,000 broken up, right? Let's say you have three products, product A, B, and C. If we know that we sell 15,000 units of product A, 1,000 of B, and 1,000 of C, then we know how many. But we need a little more information, right? Because not all of these products are sold at the same price. They're sold at different prices. So now we get down to, out of that 50,000, product A, which was the 15,000 units we sold, comes out to 37,500, right? Out of the 50,000 for the year. Product B is 7,500, product C is 5,000. So if we put that into percentages, we have 75% of what we're selling out of that 50,000 is going to be assumed to be product A, and then 15 and 10, right? Now, those are the important numbers, the units and the percentages, right? Because we can take those, we can move those to the next screen, product A, product B, product C. We have the units, we have the percentages. And now we can take that 30,000 that we know that we have for the total cost for the year, and we can apportion how much of that 30,000 needs to be covered by product A, product B, and product C, right? So we know if product A is 75%, then 75% of 30,000 is 22,500. 15% of product B is 4,500, and 10% of product C is 3,000. So we know how much we need to attribute that 30,000 of overhead to each product. And because we know how many products we're selling, or an estimate, we know $1.50 per unit of product A is how the pricing should go. So when you're doing the pricing for product A, at least $1.50 has to be set aside to cover the 30,000 of the indirect cost. $4.50 for product B and $3 for product C, if everything comes out how we think. And that's why projections and keeping track of projections and doing projections is really important in a business. You don't stop. You want to keep doing it, keep that noggin going, right? So this lets us know how much per unit if we have multiple units. But you do have to know how your business is going to run, and you do have to make an educated guess on how it's going to be broken down, how your sales are going to be broken down, at least in the units, in the percentages, right? Even if the number gets screwed up. So if we take step one, which was the direct costs, and we take step two, which was the indirect overhead cost, right? And we add those up. Those are your total cost. That should cover all of your expenses for the business. This number that you get with your direct and your overhead added together is the minimum price. You cannot sell below that without literally losing money. Now, there are businesses that sell below it because that's part of their pricing strategy. We're not going to talk about that. Right now, we're just curious of what is that minimum price that we have for a floor. That's what we should be concerned with. Okay, we know step one, step two. We got that down. That's the minimum price. Step three, profit. You as a business owner need to make profit. Now, some people might be saying, well, Pete, it's only me. So really all of the wages that I put into step one or two, all of that is me. So that's my profit. Why do I need to do more profit, right? That seems a little silly. It's like I'm double counting. Well, it does depend on how you plan to grow your business. But if you plan to grow your business at all, then step one or two is going to have the wages you pay someone else to do your business, right? And this step three is what you're going to make off of that labor, right? So step three is needed because step one and two is just the cost to do the business, whether it's yourself or a laborer that you pay. And step three is this is my reward for doing business. This is me being able to grow my business if I want. I can put it back into the business. This is my I want to take a vacation at some point. This is my I want to feel good at the end of the day that I actually made some money. Because I can tell you, one of the red flags we'll get to later is people that come in, customers that come in of mine that say, I'm really, really busy, but I don't feel like I'm making anything. And that's because they might have skipped step three, right? They might be the labor in step one and two in getting that, but they're only being paid for their hours. You need to have an extra profit above and beyond that. So keep that in mind. If you don't know how much that should be, the SBDC can pull some reports and get the typical profit margin in your industry, right? And that can give you some kind of guide of, hey, maybe I should be putting 10% profit in or 13% or whatever, right? What is typical? And that'll make me, force me to put in that profit to make sure I'm not forgetting it, right? Now, profit has taxes. So step four is don't forget to put the taxes on the profit in as well, right? Because if you make 30,000 at the end of the year for profit, the tax man's going to take 25% of that away, right? So 7,500 is going to go out. So you didn't make 30,000. So if you want to make 30,000 in profit, you got to factor in the fact that you're going to pay about 25 to 30% in taxes on your profit. So factor that in as well. If you're really, if you kind of have this bottom line of, I need to make this much to make me happy, make sure you factor in the taxes, right? Step three and four, they combine. That's your total profit margin, right? We're going to get into margin and markup in a second, but that's your profit margin is three and four together, that profit plus the taxes on the profit. That's what you make above and beyond the expenses of the business, right? Now, keep in mind, we have one more step to go to, right? A fifth step that is wholesale. But let's get what we know already all on one page, right? We have step one and two. Though step one being your direct cost, which might include labor, might not. You might put that into step two. And step two is where you have that overhead or indirect costs, which is that hardest to figure because you're trying to estimate or you're trying to project your cost and your sales for the next year, right? So that is hard. But there's a line there. Anything below that line is where you're selling your product for a loss. You don't want to be below that line. That is your line of break even, right? Then you have your needed profit and you have your taxes on your needed profit, right? Now, if you're going to be selling for wholesale, that's not where the story ends, right? You're going to be selling it to someone else who is then going to be marking it up with markup or margin, right? And let's get into that. There are three words you're going to want to know for wholesale. And you're going to want to know how they work because they're going to be common terms, right? The number one, markup. Number two, margin. Number three, keystone, right? These are the pricing terms that you want to especially know when it comes to pricing. If you want other terms for wholesale, that's where the other webinars that you missed come in. So go to YouTube and watch those, right? But for this, we're going to talk about these three. So markup, which is not margin. Very careful here. They sound the same, but they are very different. So markup is basically the amount above the cost that you're selling your product for, but it's based on the cost. That's going to come in later on. So when we calculate it, we've got the cost being the wholesale price, okay? So it's a sales price minus the cost divided by cost times 100. You know, sometimes the math gets a little wonky, but the cost is what we're interested in, dividing it by. So if we do another example, so what is the markup? If we have a item that costs, the cost being the wholesale price of $10, and it's going to be sold for $20. What is the markup on that? Well, that $10 item being marked up to $20, when we do the math, that's 100% markup, right? From 10 to 20. 100% markup because we're looking at the cost. It's 100% over the $10 that we did. Now, when you calculate your retail price and you know the markup, right? So let's say you ask someone, what is the typical markup percentage that you have? That can help you understand when you're talking to a buyer, that can help you understand what is that price my client is going to have on the other end, right? So if I sell this to you for 10, is your typical markup 100%? Because now I know my client, my ideal client that I've already researched and said they're only going to pay $15 for. If I sell it to you for 10 and your markup is 10, then guess what? Or 100% rather, and it's so 10 to 20, my clients who only want to pay $15, they're going to get a $20 bill, and they might not like that. So I really need to know from my buyer, what is your typical markup, right? So on this, I have an example just to do the math again. You know, if I have a wholesale price of $30 and the retailer says, hey, I'm going to mark it up 60%. That's just my typical, right? When you do it, you can find out, hey, if I sell it to you for $30, you mark it up by 60%, the retail price on that's going to be 48. So again, I'm thinking my end client, is my end client going to be willing to pay $48 for the retail price, right? I have to sell it for 30 because I've already done my price calculations. Maybe I have some wiggle room, but if they're going to do it by 60%, it's going to be 48 on the shelf. Is that okay? Is there any wiggle room there? Right? Or is that just the typical in the industry, or is that the typical for this particular supplier, whether it be Walmart or whoever, right? So the most likely scenario in the New England Made Trade Show would be a buyer says, hey, I mark up 125%, right? You can ask them, it's not a secret, right? Or it shouldn't be a secret, right? So you're going to take your cost, the $10, right? You're going to multiply it by the percentage, and you're going to know, okay, I need to add $12.50. That's the markup that they're going to have, right? So the final price that someone's going to have on my $10 item that I sell to this retailer, if they mark it up 125, is going to be $22.50. And again, we go back to that research we did. Will my end client like this or not? Will they buy from me at this price or not? Maybe this isn't the retailer for me, or maybe I need to negotiate something lower. But again, is 125% normal? Right? I want to make sure I do my research to make sure I know what the parameters are in my industry, right? So now we're going to kind of break it up with a little game, right? Which product do you believe has a higher markup? Just to make sure you're kind of paying attention and still awake. Do you think diamonds, bottled water, Apple iPhones, or name brand cereal? Which one? You can put it in the comments if you want. Which one do you think has the highest markup out of all of these? Someone said cereal, water. Oh, bottled water, water. Okay, some people might have seen this already. Bottled water has 4,000% markup. Generally, it costs about 5 cents to do a bottle of water, right? Then you got the diamonds. Then you got the iPhones. Surprisingly, cereal is usually on the other end, right? Versus the generic cereal. So for those people who already saw my presentation before, I made a whole nother one. Okay, so how about high school rings, bottled water, movie theater popcorn, and coffee on the go? Okay, just seeing if you guys are awake and paying attention. What do we think? What do we think out of these three? Coffee, coffee, coffee. High school rings. It is still the water, 4,000%. We got high school rings at 1,329, movie theater popcorn at 1,275, and coffee at 300. So you're actually getting a discount on your coffee. So hopefully that makes you feel better about buying your coffee today, right? Right. So good. Okay. Broke it up, but that gives you a good idea of how markup can be really instrumental when you're talking about wholesale to markup and how that changes your price, right? Now, let's get into margin, not markup, right? They're different things. So margin, rather than looking at the costs, the wholesale price, we're looking at it as the sale price. What part of the sale price, the total sale price, has the price gone up, right? So again, we're looking at sales price when we're looking at this big old calculation. You're going to get the slides, so don't worry, or you can watch the video again. So don't worry about all the math. But if we had that same $10 item that we sold $10 at wholesale, and we're thinking about selling it for $20 as the sales price, so same numbers as we had with the markup. Remember, the markup was 100%, going from 10 to 20. Here, the $10 to $20, right? There is a $10 difference, 10 and 10 to make 20. So that $10 more, when we look at the sales price, that $10 is 50% of the total price, because now we're looking at the total cost, right? So the margin is 50%. The markup is 100%, margin 50%. So they're different terms to talk about different things, a different way to talk about it. You want to know these terms because when you're talking to someone and they say, oh, I have 100% markup, a lot different than I have 100% margin, right? So you want to make sure you are talking the same language, right? So here's an example again of a $30 and a 60% gross margin this time. What does that mean if I have a $30 wholesale price and the person says, hey, there's gonna be a 60% gross margin? Well, when I go through the math, that means my $30 wholesale price is going to translate into a $75 retail price if they have to keep a gross margin of 60%. So again, we try to use the same numbers so we can compare apples to apples. The markup was a lot different. That was $48 compared to the margin, which is $75, right? So different terms mean different things. We want to make sure we understand, right? Here's another example. This is a good one for Nike. Nike, Nike. I always say it wrong. My wife always laughs at me for it. I don't know how to say it. Nike, Nike, whatever. So $100 Nike shoe. When we look at how this has actually breaks down to what the retailer margin has, Nike only makes $5 on the $100 shoe, right? That's their net profit. Everything else is their expenses. If they sell it to that wholesaler for $50, the $50 is that retailer margin, right? So if we do the math, for Nike, their margin is a 10% margin, $5 on that shoe. If we do the math on the retailer, that's a 50% margin. Now, that's a little disingenuous because that retailer is going to have their own costs that's going to cut into that. So that's not necessarily profit on the retailer side. They have employees and rent and expenses that it's going to eat into that margin. But if they were able to sell it right off the truck for no costs, people just bought it, it'd be a 50% margin. So that's kind of a good example of how to look at margin, right? From a point of view there. Now, the retailer used Keystone. So that's a little bonus hint for when we get into the next slides a little later on, which Keystone means 100% markup on a $50 cost, right? Let's get to that in a second. The more likely scenario that you're going to find at the New England Made Show is a buyer comes in and says they must maintain a 75% margin, right? We're going to take that desired profit margin of 75%. We're going to subtract it from 1. 1 minus 75% equals 0.25, right? Then we're going to take our cost and divide it by that number. So the $10 that we're using divided by 0.25 equals 40. So we know if we sell it to them for $10, they're going to sell it at a 75% margin for $40. Okay, just to make sure we did that right. Oops, let's go back one. There's the math on it, right? Because I myself was like $10 to $40. How does that happen? But that happens. So again, when you're talking to a buyer and you're talking markup and margin, know what you're talking about, right? Because markup is not gross margin. They are not the same thing. Markup is a difference in cost, whereas gross margin is a different in that sales price, that revenue, right? So markup is almost always higher than gross margin. Here is how I view it, right? Markup, if you have a $100 wholesale cost and you have a 25% markup, that means it's 25% more than the 100. So that 125 that makes up the total cost, that $25 is that 25% markup, right? Whereas gross margin, you have the same $125 because it was brought up. That $25 only represents 20% of the total price, right? But it's the same. If you look at the pictures, they're the same, except for that how you view that extra $25, right? So a side-by-side comparison, just to solidify this, right? I'm really bad at beating a dead horse, but you got markup, you got margin. Markup 100%, margin 50% for going to the bottom of the scale. They are not the same. So how do I remember them? Markup, again, is looking at the cost and how much above the cost, whereas margin is looking at the sales price as a whole and how much that went up, right? So that's where we're looking at is the difference between the two when we're looking at doing it mathematically. So I do the phrase costs march up, sales march in, right? So march up, cost is markup, march in, sales margin, right? March in, margin. See how I did that? So remember that little slogan, costs march up, sales march in. So that'll help you with understanding which one we're looking at when it's markup or margin. Right. Now, Keystone. Let's get to Keystone. I know we only got 20 minutes left. We got a lot of stuff to cover. But if you have stuff going in, let me know. So Keystone is selling your product basically at double the wholesale cost, right? If you just say Keystone. So you got a manufacturing cost, or the wholesale price and the retail price, right? So the wholesale price times 2 markup is the retail price. You're selling it for $40. They're saying, oh, we do Keystone. That might be something you hear at the New England Made Show. We do Keystone. So if I sell it to you for 40, you're going to put it on the shelf at 80, right? You're just going to double the price, right? There's a 2 times markup. It is the go-to rule of thumb that I've seen at the New England Show, right? Now, there are other industries that do triple key. There are some that do key and a half. So you do want to look at your industry. Restaurant and food tends to be a little lower. Retail grocers even lower. So that's where the SBDC can also help, is trying to find those rules of thumb of what the keystone is. But again, when I go into the show, what I usually hear from the buyers is we do keystone. That's what they say. And that means we're going to double the price you sell it at. So if you sell it for 10, we're going to put it on the shelf for 20. Right? Or you can ask them, well, is there a margin or a markup that you need to stick to? And that can help you as well. But we've gone through all of those, right? So let's look at all of what we've done with numbers on one page, right? We got the material, ingredients, or packaging, and this is for the jeweler, right? So let's say $7.35 is the material, ingredients, and packaging for an earring. Earrings, I should say. You don't just buy one, right? The labor, right, takes 60 minutes to make 3 earrings. So the labor was $7, right? And the overhead, right, we had to kind of assume what the monthly cost would be and the customers, and we put that into an annual figure. We assumed it was constant throughout the year, which is hard, right? For Maine, you might have seasonality. So keep that in mind, right? But we figured the overhead cost, step 2, was $20 per earring. So that makes $34.35. That means we cannot sell these earrings for less than $34.35 without losing money. Then we add in the profit, and let's say 20%, right? So $41.22. We add in the taxes on that extra profit, so it's a buck 72 added. So now it's 42.94, and then we're going to sell it wholesale, right? And it would, when you do the math, if we do Keystone, it's 85.88, but everyone likes the psychology of a nice round number, so 89.99 with MSRP, right? So I can assume if I sell these for about 42.94 per earring, that they're going to hit the shelf at 89.99. Will my ideal client buy this or not? That's the real question, right? Depends on the earrings. The problem with cost basis, what we just did, is knowing your true cost, because you have to guess, right? Increased production can lead to increased costs. You also, how do you apply stuff? Because you could buy in bulk quantities and that could lower your cost. Knowing you have to guess at the sales and the cost. So there's some of that guessing. And you might have to figure out if there's going to be a large growth in the next 3 years is how I look out. And you might want to factor in for that growth, right? So remember that. But that's kind of your first one, right? As you do that cost basis. Remember, you don't do just one, you do three. And I said I was going to go into cost basis quite a bit. So after you establish your cost basis, then you go to the competitor prices, right? What is my market basis, right? So the competitor pricing is your market basis. That's, hey, what is everyone else selling their product or similar products saying about their products, or what are they selling it for? Well, I'm not saying you have to match it. You just have to know where they are, because they might be targeting a whole different demographic than what you're targeting. So Walmart is not targeting the same people as, Rolex watch, right? They're different targets, different reasons. One's quantity over quality, one's quality over quantity. So we also want to look at what the typical margin and markup is in the industry, and keep in mind that some things can affect it. So when you're a home-based business, you might have a very small overhead. Whereas if you're looking at a competitor that is larger, they might have a large overhead, and that might be why their product is selling at a higher cost. Doesn't mean you should stick to the home product, right? It just means, hey, this is where my price sits among everything. Now, ideally, your price is lower than everyone else's, so that gives you wiggle room to bring your price up. If you do the math on the cost basis and you look at your competitors and your price is way above everyone else, well, then you got to think about the marketing you're doing. Do you truly have a product that is worth more money than the alternative? If you do, that's great, but you really got to hone in on that marketing, because people are going to look at the other alternatives and say, I could buy this for half the price, right? Not the end of the story, but you need to know where your competitors sit and how they're sitting to understand your pricing and where you want your pricing to be. Right. Now, you can also do a fun reverse engineering of retail pricing. Again, keeping in mind that you don't know the full story when you see an item on a shelf. But if you know, hey, I've talked to this retailer and I know what their typical markup is, and I can see my competitor on their shelf at this price, you can kind of do the reverse math and try to assume what their costs are. Again, it's a lot of assumptions, but then you can try to kind of figure out what their wholesale price might have been. So if I saw a thing on the shelf for $60 at a retail price, if I did the math, maybe I could figure out, oh, the wholesale price is about $32, I think is what they're selling to that. So there is some fun math things you can do when you find your competitors as well. Again, you don't know the whole story, but it is kind of fun to do, to see where you sit and what profit margins they might be getting, right? Again, this is a part of the math. I'm going to send you the slides so you can look at that. Market perception, right? So we had to find the competitor, understand the competitor, do some math with the competitor, try to figure out where you are. The market perception, which is your brand. A lot of people, when they start businesses, they ignore the brand. They go to step one, the cost basis, step two, the competitor basis. Step three, they might not have a brand at this point, but a brand is something you need to start from day one. Because if you can grow your brand, then you'll be able to break the chains of step one and step two. You won't have to worry about the cost. You won't have to worry about the competitor, because your brand is going to elevate you above what both of those would say you would have to sell your product for, right? So it starts day one. You need to work on your brand. And again, the research of, well, who is your core client? Who is that, right? What price are they expecting to pay? Most clients have some kind of perceived value in there. Other factors could be emotions that you try to elicit through your marketing, the utility, the availability, the appearance. There's a lot of stuff that goes into a brand, and you don't want to mismatch your brand with the wrong retailer if you're doing wholesale, right? So if I'm selling something and it's between Walmart and LL Bean, well, those are two very different retailers with different branding of their own. So I want to make sure my brand is more aligned with the brand that I'm going to be putting my retail in. So in this case, kind of an example of how brand can help you get above the pricing. An Apple iPhone only costs $490.50. Total production cost, total cost. That's the profit of all the people that work at Apple. That's the shipping cost, the marketing cost, the total cost for that. So anything above that is literally profit, and they can retail for over $1,000 easily. That's because Apple has built the brand that says, "Hey, we can charge what we want on these phones. People will buy it because they are brand loyal." Right? So that's what you're looking for with your business. That's an extreme example, but you want to start from day one. What is my brand? It's going to matter, right? So to do this, you can do a customer survey, you can do a focus group. There's something called the Van Westendorp pricing model, where you ask these four specific questions. When you put those questions into the model, it gets you a nice range. I know this graph is like, whoa, but it gets you a nice range of, okay, it's between 350 and a little under $6 is the acceptable range of what people are willing to buy my products for. So there are ways that you can kind of test the market and try to figure this out. And this is things you can do as you go. This isn't something you do just when you start up. You can, if you're thinking about a price increase or a new product, you can kind of test the market and see what they're willing to pay before you put that on there, because you don't want a mismatch of price, right? There is the Pareto principle in business, right? It's an 80-20 rule. 80% of your outcome comes from 20% of the causes. So what I like to kind of point out with this is basically, really, when you get down to it, everybody's not your customer. If you're getting 100% of sales and you can't, and they're flying off the shelf, that's probably a little red flag to you that they're seeing a great value there. And there might be a pricing mismatch. So just remember that everybody is not your customer. That's okay in business. Embrace that. You're not going to be able to please everyone with your product. That's okay, right? Now, remember, as a business owner, you have to remember all three of these: cost basis, competition, and your brand. All of those at once. I usually go from top to bottom, right? And figure that out with the client. Um, some strategies. Remember, I said I do this really quick, and I know I don't have much time left, but some strategies which are not price point determination. That's what we just did, price point determination. Some common strategies are like Walmart, market penetration, prices set low to capture the market share. Apple, they they bring out one phone and then that phone becomes an old phone and bring out a new phone. So the new product is reduced over time, right? Location price in stadiums. When you buy a beer at a baseball game, it's going to be a little higher cost than somewhere else, right? Bundle pricing. Internet loves this, right? Oh, do you want this and this and that? Adding things on. Psychology pricing, the BOGO, the 99 versus a dollar. That's based on emotional drivers. Perceived value, like Coach and Rolex are buying based off of their branding. Price lining, so vehicles, you start with a base model and build up on that. Competitor pricing, gas stations are famous for this, right? If you don't believe how many miles people will drive for like a 2 cent difference in gas price. But some red flags you want to know for too low pricing is you receive a high percentage of your orders, you're selling out of your products, your lead time is stretching, so the time that you can fulfill orders is stretching out way too far, your profit margin's going down, so you're not making as much money as you think. Or what I hear a lot, I haven't implemented a price increase in a long time. Helpful hint, every year your price should be different because every year your costs are different, right? Your costs are usually going up. So your price needs to go up. The best example I can think of is coffee. When I buy my Dunkin' Donuts or Starbucks or whatever, 10 years ago it was $1.50. Now it's like $3.50. Can I point to one time in history where it went up? No, because they raise their price every 3 to 5 months. They've just raised it as they go. And it's not a shock to my system now that I'm paying double what I used to be paying. But if you go out as a business and you haven't increased the price in a long time and then you suddenly have to double and your price is higher than a cup of coffee, they're probably going to notice. Your clients, you're going to lose some clients that way. So think of, hey, if I haven't done something in a long time, maybe I do need to do something. I need to go back to my cost and figure out what my minimum price is, right? Um, Alternatives, if your pricing is too high, right? If you're on the other end, that was price was too low. If you're on the other end, if your market will not accept the product, right? Either you can do nothing, you just accept a lower margin. So I see some people do this. So that means you make less money, right? Or you can try to differentiate your product through marketing to say it's more valuable than the other competitors. You can discontinue your product. Just because you have a product and it's been going for a while doesn't mean you can't change a product or discontinue it, change a color, or look at making it cheaper, whatever. You can try to reduce costs, right? So there are ways that you can look at if your price is too high. So too low, problem, too high, problem. But ways that you can get around it. Again, SBDC is here to help if you need to talk through what maybe your best option is, right? So how to reduce costs, you look at direct, indirect, discount on bulk ordering, reduce labor time, hire someone. It sounds weird, but sometimes hiring a specialist can reduce your overall cost. You can try to join forces, though I haven't really seen much of that happening. It's more of my pipe dream for that last one, right? But I'm going to end with two basic rules of pricing from my mentor, John Entwistle, legend here at the SBDC. The market, not your cost, determines the price at which your products will sell, and your cost and desired profits only establish a price floor below which you cannot sell to make a profit. Two rules to live by, right? Now, to recap, so know your product, know your market, know your price. Remember, price is complicated if you're just doing, remember that family feud in the beginning, if you're just doing one of those things to find your price, then hey, kudos that you're doing something rather than your gut. But really, what we want to know is what is the right price? Am I going to be happy, right? Because I need to make a certain amount of money to make me happy or to let me grow my business. And if I do it wrong, my business is not going to grow. I'm not going to be happy. And eventually, maybe I'll close the business. So you really want to look at all the steps that we did. I know I went through it fast. I'm a fast talker. That's why we record it so we can put it on YouTube so you can see it later. But with that being said, thank you. Thank you for listening. Thank you for being here. I know I gave us all of 2 minutes to answer some of these questions. Again, you will get the slides. The YouTube will be a little more informative because some of the slides I have animations that come in and block them. And some people have asked me before about having some computer models that help with understanding markup and margin and stuff like that. So I will include this slide where you can figure out markup, margin, or both if you wanted to do it on the computer. Okay, so I'm going to stop sharing and let's see if we got some questions going on. I don't know where to start. I don't know if someone's, let me see. I can start from the top. Oh, yes, Janelle Abbott, Staley. Hey, from New England Made. Oh, and Ed Miles. Everyone have a shout out for Ed Miles, my big buddy. Hey. Yay! We got a lot of cereal water. Cereal Ed. Ice cream and popcorn. I know we got a question in here. What about this year with tariffs and crazy inflation? I will raise twice. Have others done the same? Inflation, not just this year. I mean, hypothetically, inflation's under control this year. But in the last 3 or 4 years, especially when you add it up, it's been a crazy year for inflation. Typically, the advisors will say expect 3 to 4% inflation per year. It's been higher than that in the near past. So the fact that you have to raise your cost one, the consumer is pretty much assuming it because they hear it on the news all the time about tariffs and inflation. So it's not really a shock to the consumer anymore when they see the price go up, not as much as if there was nothing going on in the news. So I think a lot of people have had to raise their prices, and I think it's okay as long as you're doing it in a systematic way where it makes sense, as in this is how much I need to raise. You're not just arbitrarily saying, oh, I'm just going to double it, right? But if you have a systematic, like, hey, costs have gone up. Some people have even, I've seen stores where they say, sorry, costs have gone up, but this particular cost has gone up, so I had to do this. So especially with tariffs. Um, so I have seen others do the same. I got a longer questionnaire. I make soaps, so I kept the same price. I reduced the size of a bar last year. It is advisable to just increase costs for wholesale online, but keep prices the same in person, like at farmers markets, trade shows, craft fairs. This knows, but I kept the same price. I reduced the size of the bar last year. Is it advisable to just increase costs for wholesale online, but keep prices the same in person? Well, there's a could you increase the costs wholesale? Yes, but that's going to translate into a higher cost retail. And the tricky part there is if you keep your costs low, so like people can come to your website directly and buy it cheaper than they can in the retail store, your retail stores are going to get pretty mad, right? There are savvy shoppers out there who are going to use their phone and be like, oh, dude, I can save like $3 if I order it directly from the manufacturer versus, you know, um, buying this here right now in the store. So that's why it's usually you have some kind of agreement with that retailer, like, hey, you can do whatever you want with your price, but this is the price we suggest, manufacturer's suggested retail price, MSRP, that's where that comes from. This is what we suggest you sell it at. And then we kind of stick to that saying, we're going to not undercut you in the back here. We're not going to undercut you and sell it for cheaper because we know you need to make your margin. Now, if you want to sell it for cheaper, you, the retailer, want to buy it for $10 and only sell it for $10 on your retail shop, go for it. But there is a relationship that you need to maintain, and it's a very sour relationship you will have if you are selling it for cheaper and your sales, people are finding out about it in the retailer, and then the sales are getting directed back to you because you're cheaper. So you could find that your relationships are sour if you try to do that strategy. Um, hopefully that raises it. Better to just raise your price, all of it. Where's this other market? A lot of retailers, like coffee especially, they keep the price the same because people are used to that price, but they reduce the amount, right? If you see it. I think I saw orange juice was doing it a lot lately, right? You don't get the same size orange juice you used to. I don't want to reduce size as I have set containers. Yep, if you don't want to reduce size, you don't have to. But remember, it's one of two options. If your costs have gone up, either you have to raise your prices to match that, or you have to be willing to eat that, as far as that's profit I'm gonna lose, right? With the exception of, we never want to go below that. Remember, step one and step two to get our break even price. We never go below that because then we're just losing money. Unless we're doing some kind of crazy strategy that we're bundling, this one with this one. This one's at a loss, but this one makes up the difference, right? So there are some strategies you can do, but in the general rule of thumb, never go below that kind of break even, right? Um, I have a wholesale accounts paying different amounts. How do I increase and have them pay the same across the board? I sell dog ice cream. Dog ice cream. Is dog ice cream different than human ice cream? Now I'm really curious. Now I'm like, I kind of want
Yeah.
some dog ice cream. So
Yeah.
if you have wholesale accounts paying different amounts, oh, are you hey?
Yeah.
Um, so if you wanted to, I mean, again, it's a relationship.
Right.
So could you kind of go back to the ones that are paying less and say, hey, I'm just across the board. This is what my wholesale prices are. Sure.
Hmm.
It's harder. I find the price discrepancy usually comes in when you first started and you signed up with someone and they're kind of loyal to you, and you're like, I don't really want to increase the price, but
Right.
all these other people are paying more, so I feel like I need to. So it's either you can maintain that relationship, maybe raise their price, but let them know I raised your price, but not as much as everyone else, right?
Okay.
So everyone else got 10% increase, you're a five, right?
Right.
So I'm still kind of brand loyal, I'm loyal to you because you've been with me since the beginning. Or maybe you put a bigger discount on larger orders, kind of try to push them into a larger order bucket. But even if they've been with you since the beginning, you still have to make a certain amount of money to keep the business growing. And everyone knows that, right?
Okay.
So can you devise some kind of strategy to keep them happy? Yes. Would I do it at the cost of shooting myself in my foot? No.
Okay.
And
Great.
and they understand. It's a business. They understand, right?
Yeah. Yeah. I
Yeah.
mean, I have different clients, like their margins are enormous
Yeah.
versus
Yeah. So yeah, so
okay.
they're making money. They're happy. They're
Mhm.
going to be able to absorb that probably. The other things you can do that don't cost is you could say, "Hey, I'm raising my price, but for you, that price will be the same for a month later." Right. So you'll have a whole month that other people don't have that you can order it at a lower price if you want to bulk up on it. Right. So there are shifty ways you can do it that you can still say, I really like you. I like this relationship, but the price is this is what the price is going to be, right? Because this is what I need. It's business. This is what I need to make on the deal.
Okay. Thank you.
Yep. I have heard that buyers want an even bigger discount for bulk. I had one that wanted 350 of two products, wanted more than my wholesale price. Uh, to a discount. So I said no. Oh, um, so there is this common perception from uh, from the buyers that if they buy a larger quantity, that should equate into some kind of discount. And again, you'd have to kind of go through your pricing model, and hopefully before that time, you've priced in. Okay, if you buy one box, this is the price. If you buy five boxes, maybe the price is lower because I want to incentivize you to buy five boxes, right? If you built that in from the very beginning, great. If you didn't and they're asking, then you can either just say, nope, I'm a small business. Each box is priced at this price point. I'll think about discounts in the future because I know that's important to you. Or you can cut into your profit and offer a discount now. Or before you even get there, you can kind of figure out, okay, I'm selling wholesale. Remember, this is all part of a pricing strategy. My pricing strategy is I want to disincentivize people from buying just one box. So maybe I increase the price a little bit for that one box. And then when I look at the five boxes, there's at the price I do want to sell it at because I want people to buy it there. I don't want them to buy one box, right? So you kind of do the reverse. One box is more expensive to buy than if you bought five boxes, right? And that's where my pricing is. I'm pricing for this is my ideal. Remember, that's the research of understanding your ideal client. Part of that is how much is my ideal client, which in this case is a retailer. How much is my ideal client, the retailer, going to put in for an order on average, right? And that's hard to tell because when you first start out, they're probably a small order just to test you out. But you do want to, as a wholesaler, decide what is my ideal bulk sale? Am I going to have any discounts? If you are, build that into your price from the get-go. If you aren't, you just have to be pretty straightforward. Like there's no discount. We're a small business, right? Sometimes I do see small businesses kind of bullied by larger retailers, either usually not in the beginning because they want the business, but at some point the larger retailer kind of puts the weight like, hey, this is a big order from a really prestigious business. You should really be happy about this order. And you're kind of like, man, should I be happy? Right? So remember, it's all about relationship. Does that order matter? What are your rules and policies? Have you built it into your pricing? The crazy thing about business is it's not a matter of right and wrong. It's a matter of pros and cons, right? So common in business. Hopefully that answered the question. And I'm glad you said no. On a side note. All right. Any other questions? I know I've kept you guys. Oh my God, 10 minutes past. I'm so sorry. Thank you for everyone who stayed on. I know that people might have had to jump off. I think the Q&A will be part of the overall webinar. Um, Hopefully, no one also forgets, how we started with the main Shagamawa. What is it? The main tote road Shagamawa. Don't forget that. Suddenly they'll be selling stickers of that, and they'll be like, "Why is this suddenly popular?" Well, it's because of me. All right. Yes. Thank you for everyone. Again, my email's right here. So if you have specific questions to your business, by all means, feel free to email me. If you want advising from an advisor, just go to our website and click that advising. If you have any questions about the show, I really highly encourage you to go to especially the next two. The next one about the booths is really informative about what to expect on just putting your booth together. And the fifth one rather about the what to expect from the show itself is really informative because then you kind of know what you're getting into when you watch both of them. And then worst case scenario, right? I always say you just need to go, right? And there's ways, I hate to say this because I'm putting Steph on the spot, right? But there could be ways we can try to get you. Usually it's just buyers, right? This is a professional show with buyers. So it's not like a craft fair where people come in just mosey. So we want to limit that. But if you're serious, you're like, hey, I really just need to see the show, maybe there's a way we can do that, right? So
We can definitely, Peter, take care of that. They just have to reach out to our office and we have some special arrangements and we're glad to take care of them.
yeah. And I tell people if you're on the fence at all, try to get there because being there is a lot different than just seeing it on the webinars here, right? It's a whole different atmosphere. It's intense and it's great, but and that's why we do these webinars to prep you guys for this, right? It's kind of like prepping for game day here. Get my chips, my salsa. Okay, if there's no other questions, again, thank you for staying. It's 12 past. Sorry if I cut into people's lunchtime. This will be put onto YouTube. YouTube? Yeah. YouTube on our channel. If you signed up, will get the slides and you'll get a link to the YouTube. And thank you again for joining us.
Thank you, Peter.